Aditya. We are in the middle of a global market sell-off. A lot of jitters all around us. Investors have a lot of questions on their minds. So I thought, why not take views from one of our most reputed fund managers and understand how you manage to remain so calm and poised despite what's happening all around us.
So essentially it is as a part of investing process. I think so it is most of the time that is about getting yourself prepared. Nobody can predict what can play out, especially the macro conditions that we are witnessing at this juncture, but we can always prepare ourselves, and going by past experiences, one thing is very, very clear. So if you look at the investing process, it comprises of buying, sizing and selling, and at times selling comes to the fore, and it is nothing but being disciplined across market cycles and then thinking a lot objectively about whether incrementally we can generate the same kind of performance that we have been in a position to generate for our investors. And at times taking some money off the table helps investors to meet the financial goals that they have set for themselves. So time and again market has reminded us that once you stay disciplined across cycles, it comes to the fore and it helps to achieve the long-term objective that investors would have kept in mind while investing.
So, in fact, in just 2 weeks back, we were remembering that you took that now in hindsight, right, a very, very astute decision of booking profits and closing your, fund and returning the capital and the profits to your clients. What prompted that decision? We believe the fund was anyway set to kind of close 2 months down the line, right? So just tell us more about what prompted you to do that.
So if you look at the sequence of events today, clearly, we didn't really wanted to run a budget risk, essentially, going into the budget. So that was the first thing, the foremost thing from a domestic economy perspective, which was on the top of our minds. So if you look at the shape of the domestic economy today, whether there is enough to worry about in terms of current account deficit or fiscal deficit or leverage, these have been the three basic reasons why, in the previous cycles, one investor could have been worried about. But clearly, what is also getting highlighted and what is very, very unique about this rally globally was that for 14 months in a row, we didn't see even a 2.5% correction in the Dow Jones Industrial Average. Now, if you put those things into context, and if you just think about it, that they say that bull markets always climb a wall of worry, and suddenly what we were seeing was that there was nothing to worry about on the domestic front. So that was one. Clearly there are certain risks which are not getting highlighted. Now I think so it is reasonably clear that if you look at the devaluation of the yen versus dollar which has played out, and the subsequent rise of yen to the surge of to the tune of 13.4% since July 10, this has led to unwinding of carry trades. Obviously, this has also put pressure to the entire Asia complex in terms of the markets, and this is getting reflected in performance of the Nikkei, Kospi, Taiwan topics. Essentially, if you look at indices in US, so this brings us to a very, very important juncture in the market because the world is still intertwined, and there is a lot of talk about, time and again there is a talk about investors in India that the India market has decoupled. Now when global macro risks come to the fore, it is a rude awakening for investors in India as well. We might be focusing a lot on SIP flows, obviously, which have been very, very constructive, but there are certain risks that nobody can predict. Secondly, I think so it has also got to do with the health of the US economy today. What we are seeing, the data at the periphery is deteriorating at a very, very rapid pace. So we are looking at things like housing market default, or credit card defaults, and it is also getting reflected in the way some of the larger US banks are reporting numbers. So I think so possibly there is a widely anticipation now that Fed is going to cut rates, and possibly Fed would have to cut rates very aggressively. And there was also a talk about emergency Fed meeting coming to the fore, and if that all of this is true, that also means that the magnitude of problem seems to be slightly elevated at this juncture. We have seen the third record reading as far as the VIX is concerned. The VIX index rose to 65 temporarily. This is the third time which has happened in history. So I think so volatility is going to be here to sort of stay for a longer period of time. So it is just that volatility has returned with a vengeance. So it makes a lot of sense to put your head down, calm your nerves, possibly focus on fundamentals. And as the sort of storm passes by, I think so again Indian markets would resume the uptrend. But for all of that to happen, possibly corrections are need to be well capitalized from an investor's perspective in terms of putting incremental money to work.
And Aditya, you still see those pockets of value for your own PMSs that you're running? You continue to see those in India even as we speak?
Yeah, so I think so broadly, from a PMS standpoint, it makes sense to, focus on value stroke growth at reasonable price as a style, and that is what we continue to do. We have been value seekers, so we are working on two scenarios in the market. Either we get a headline index correction of 10-15%. That means that possibly some of the stocks will correct by 25-30%. And that is what we are witnessing since we are in the middle of earnings season. It would be logical to expect wherever we see earnings disappointment, those companies can be bought into. So purely from a bottom-up perspective, I think so we are at a very important juncture, because in the Indian market there is one complex which is very set of stocks which are very expensive to own, and I firmly believe that 5 to 7 year return in certain segments of the market could be zero, because some of these companies, at least we find them to be valuations are very overheated, but at the same time there are some opportunities in sectors which have not done well, some companies which have obviously faced some sort of headwind. So we continue to focus on value picking in this environment. We have been contrarian in the sense that we would like to wait and watch for certain companies, and when they disappoint, that is a time to buy structural names in the market.
On that note, very interesting note, we'll catch up with you again. Thank you so much for your time, Aditya.
Thanks a lot for having me.